Good afternoon, everybody, and welcome to the next segment. I am Penny Garton. I work for CDC Small Business Finance, and we appreciate you all taking the time today to go through the application to credit. And we're going to get started here. And at the end, we will have time to do questions. We can also pause in between if there's some clarification needing. If you have questions, you can drop them either in the chat box or you can raise your hand at the end and we'll go through those questions as best we can. A slide deck, presentation packet, or I'm sorry, PDF can be supplied out to you all also. So don't worry about taking notes. They can send it out to you afterwards. So let's get started with our slide one. Okay, so as I stated, I am Penny Garton. I am the sales manager for the national sales team. We do the small business lending throughout the United States, and my team sits throughout the United States. We predominantly do an SBA loan called the Community Advantage. I'll give you a little bit of guidelines about that at the end. And we are the largest lender in the United States for this program. We put up anywhere between 70 to 73 million a year on various programs, particularly on the SBA loan. We put up about 48 million a year in the program that you're going to see later on. Next slide. So topics we're going to cover today. So you're going from credit application to capital, and also talking about credit. And basically, I'm going to give you some guidelines on how to build that profile that we lenders are looking for. So we're going to talk about areas of evaluation. What is the SBA? I will let you know there's been a lot of recent changes over the past 2 weeks. In fact, one just came down yesterday. We're also going to talk about what's the difference between traditional lending and alternative lending, what the funds can be used for, and what work are you going to be doing to get prepared and ready to submit over to the lenders. Next slide. Okay, so these are the areas that we evaluate. Credit, which is the character. We're looking at how you pay your bills. What is the experience? How much revolving debt do you owe? Are you over leveraged? Those are the things that we're looking for in credit and character. Capacity, we're talking about cash flow. Capital, we're talking about liquidity, checking, savings, investment accounts, etc. Collateral, do you have any? Because some lenders do require that you have collateral. Not all, and it does not kill your deal if you don't. And then what are the conditions, meaning what is your experience in that industry? A few changes have occurred regarding the conditions and experience. Now SBA is asking for minimum 2 years direct industry experience. So that's one of the new recent changes that went into effect April 1st. Next slide. Okay, so credit. Whose credit do we review? As you can see, if you're a business owner and there's multiple owners, 20% or more ownership in the business must have their credit pulled and guarantee the loan. Now, there are a few different caveats to that. For example, let's say you have a 90-10. You're 90% owner and your partner is 10%. You're the 90% owner because maybe you come with the experience in the licensing, but that 10% owner did the initial down payment or injection is what we call it in our world. Then that 10% borrower, that 10% owner is going to need to guarantee that loan, okay? Spouses of the business owners, we're going to pull their credit because we have to account for all household debt, whether or not the spouse owns any part of the business or brings any secondary income at all into the deal. If those are both no's, we still have to pull the credit. It is a requirement. And then anyone else that is required to guarantee the loan. Now, what does that mean? That could mean beyond a business owner, maybe there's a key employee who holds the maybe licensing or experience to that business. They would be required to guarantee the loan because without them, you can't conduct business or go forward with any kind of expansion of any sort. So what are we looking at when we're looking at the credit? How you pay your bills, how much revolving debt do you owe and what is available? What is your leverage? That means debt to assets. So we're looking at liabilities. How much do you owe versus how much do you have in assets to offset that? The length of your credit history, meaning what's your oldest debt, how long you've been in the credit file, and then what type of loans or debt or revolving debt do you have outstanding? Now, I always recommend before you get started on applying for any kind of loan, whether it's commercial or personal lending, pull your credit report. You can go to annualcreditreport.com. You can get a free credit report every year. Check it, make sure everything is accurately being reported on there. Any items that are not, please dispute them. What happens when you dispute, you could do it online, dispute through the bureaus, all three, and then they have 30 days to review it with that creditor. If the creditor does not respond, they have to remove it. Or if it's reported incorrectly, they will then correct it. Next slide. Okay, capacity and cash flow. Now, I know a lot of this has already been gone through in past workshops, but we're just retouching the basis here. So capacity and cash flow, we're talking about business income plus personal income, and you can see personal income includes the various options or bullet points below. And then that'll equal your cash flow for personal and business debt repayment. So why do we look at it that way? Well, if you're the business, meaning you're maybe a sole member or you're the sole shareholder, we're looking at your business income that you're bringing in, your net income, and it should be net positive. If it's net negative on the business income, there's only a few things we can add back in. One of them is depreciation. The other is interest. The third is amortization. And then the fourth would be if you had any one-time large capital expenditures, we could add those back in because that's not a year-over-year recurring expense. So what are those one-time capital expenditures? Well, maybe let's say you did some tenant improvements or renovations to your building, to your business location. You don't do that every year, so you would need to just let the lender know and then supply the verification of it. Or maybe you had to set up new servers or new computers, something of that sort. Or maybe you purchased one piece of new equipment that you don't purchase year over year. Those are things you need to bring to the lender's attention so that way we can add it back in. Personal income, if you are a startup, we are looking for secondary income, secondary household income. That's where the spouse comes in. We are looking for investment income, retirement income, anything of that sort. That's considered personal income. And then the total of those will equal your cash available to pay the debt. Okay, so that's what we're talking about, capacity and cash flow. Next slide. Okay, now, existing business financials. When we're talking about cash flow, these are some very important things when we're talking about business cash flow. So existing businesses only, but you startup entrepreneurs, kind of take note of this, go forward. So why is a profit and loss important? A lot of folks, a lot of business owners, they don't do them monthly. Sometimes they do them quarterly, or sometimes they just don't do them at all. If you are borrowing money, you will need to have these done monthly because it gives us a snapshot in that time period of how the business is doing, which essentially as a business owner, that's what you should also be looking at as well. It's very important to understand the financial health of your business, okay? Expenses should be reported and categorized correctly. and your year to date for each month should be done by the 10th of the following month. So for example, all the April financials, profit, loss, and balance statements should have been completed by May 10th, because that's when we're going to ask for them. Okay. And then lastly, as you see that I said a few minutes ago, it gives the owner of an idea if you are on track or off track. And if you're off track, you could look at those lines and figure out, where am I off track? Also, what not to do on your financials, okay, on your profit, loss, and balance statements, specifically under expenses. You don't want to pay any personal debt out of the business and report it on your business financials. Sometimes some businesses will hide it in another line or just account for it and categorize it as such. What that does is it is decreasing the business value. So let's say you have this great business and maybe you're either planning to retire or maybe you're just ready to move on to your next project, and so you're going to sell this business. The evaluations are based on your financials. They're heavily weighted. So if you're putting all of your personal expenses into that business expense lines, you are decreasing the value of your business. So if you think your business is worth $1 million, but it only evaluates for 500,000, $500,000, it could be one of those factors making it be less valued because of that. Okay. So real important. If you are a business owner and you're the sole, and maybe that's how you pay yourself, do a draw and do it against either owner's compensation or maybe against a distribution. You could do it that way as well. You can also pay yourself a salary, and that would not become a negative against the company. Okay. On the balance statement, sometimes there are negative balances showing because maybe things have been prepaid or the GL line just wasn't balanced. You want to make sure that it's not showing negatives on there, or maybe it needs to be zeroed out because it's already been paid off. For some reason, it's still flowing through there. You want to check your financial software. Okay, and then also if you take cash, you want to report it. So do not report the cash. Make sure you report it. That's part of your revenue. It is important to do. If you're looking for any kind of software, one good software that gives you good reports, pretty easy to navigate, and you can actually do class trainings online, is QuickBooks, and I put the link right down there to peruse. I will recommend though, if you have a specialty business, sometimes that specialty line will also carry a specific software for you to use, or maybe a franchise. Some franchisors use a specific reporting software. Next slide. Okay, capital. What is capital? It's the money that you're bringing into the business. It's liquid assets. It's what you can get your hands on today to use if you needed to pay bills, pay something off, or put into a project. Okay, so checking, savings, marketable securities, cryptocurrency. Some folks have a home equity line of credit. You can access that. Partner contributions, maybe you input some capital back into the business, or gifted funds. Gifted funds are considered no repayment necessary on those, okay? How much injection or down payment is required if you're starting a business? 10% injection is required based on your overall project size, okay? Business acquisitions, if you're buying a business, you will also need a 10% injection for that amount as well. So let's talk about business acquisitions for a moment. If you're looking to purchase a business and the purchase price is $100,000, and you go through and maybe you need to do some upgraded equipment, or maybe you need to buy equipment, and you're going to need some working and operating capital, and that loan amount now increases to $150,000. That 10% injection is based on that loan amount, not the purchase price. So if the purchase price is 100,000 and you need 50,000 more, then your injection requirement is 10% on the 150,000. Okay, so 15,000. Reserve funds. We call this post-injection liquidity. That means, what do you have after you've injected your 10%? It's going to range anywhere from 10 to 20%, depending on the lender. But we are looking to see, what do you have to fall back on in case anything happens, either household or on business side. All right. Next slide. Okay. So what is the SBA? SBA stands for Small Business Administration. SBA is a government agency. It is a part of the federal government. It does not make loans directly to the businesses. The only time that it did was in the disaster loans. So if you have an EIDL loan, an EIDL loan, that is the only time that the SBA does the loan directly. How do they do that? Well, they recruit folks like myself, who is previously an underwriter, to go work for them for so long on contract, and you do those loans. You get them ready, you underwrite them, you approve them, and you get them on the SBA books. That's the only time. The rest of the loans out there that you hear SBA are done by lenders like myself. I work for what is called a certified development company. That's where the CDC comes from. And then you can see the other entities that also do SBA lending. A CDFI is a community development financial institution. Traditional banks, both community and national and global. And then there's various online lenders that also do the SBA loans, okay? So direct lenders, we provide it directly to the clients, and the SBA gives us lenders a guarantee on the loans, like an insurance policy, up to 85%. Why do they do that? It lessens the risk for lenders like ourselves, where we can do up to a 90% loan amount request, whether it is working, operating, capital, startup equipment, or if it's a piece of commercial real estate. So that's the SBA. Next slide. Okay. Traditional lenders versus alternative lenders. Traditional lenders are your banks, your traditional banks like the B of A's, the Wells Fargo's, community banks. That is your traditional lending. Alternative lenders are like the company I work for. We're considered an alternative lender because we don't have deposits. We only do loans. We do loans and business counseling. That's all we do. We do government lending. We do non-traditional lending. We do commercial real estate lending, and of course the small business lending, which is up to 350,000. And then we also do, some of our companies do what we call investor lending. And what is that? That's when you have a business that's at a certain stage of its business cycle that maybe is taking on large scale wholesale products. Maybe they're going to start selling their product to a big national grocery chain, and they need to buy a larger size warehouse, and it's more than $2 million. That is what investment financing is. Okay, so why are we different, alternative lenders different from the banks? Well, we do startup businesses. That's about 70+% of our business. We also do early stage businesses. So an early stage is considered anywhere between 13 and 24 months. We can look at a lower cash flow requirement than the banks. Traditional banks require what we call a 1.25 to 1 ratio. So what does that ratio mean? That means for every dollar of debt, that's what the 1 is, you need to have a $1.25 in net revenue of your company to pay that debt. Okay, so 1.25. That's for traditional lenders. Alternative lenders, we can go down to a 1.10. That's the baseline for if you're doing SBA lending. We can also do projection-based lending. And then we also can do loans where there is small pieces of collateral to no collateral. And we can also do smaller loan requests. That's mostly below the $350,000 requests. All right, next slide, please. Okay, here's what a lot of folks ask. What can I use this money for that I'm borrowing from either traditional lending or alternative lenders? You can see that the majority of the requests are for working capital because new hires, product development, legal, capital expenditures, marketing, a lot of that will fall under working capital. So that's where we see a lot of loan requests come in. Inventory, supplies, startup, debt refinance, existing businesses, you can request debt refinance. If you're buying a franchise, the franchise fee can be financed. Sometimes the franchisors will have some lenders they already work with, but you can go to any lender that you choose. All right, next slide, please. Okay, now here's the meat of most of this, preparing to submit. So as I said earlier, check your credit one time a year or before you apply. If you see that your revolving debt usage is high, if it's above 30–40%, you want to start paying that down. Those are numbers that we look at. You don't want to have a lot of revolving debt out there. If you have any draw credit, past due, unpaid collections, tax liens, anything of that sort, you either want to get those settled and cleared, or you want to get yourself on a payment plan. Now, the thing about the payment plan, most lenders require that you've been making those payments for minimum 6 months. Okay, so get yourself prepared. Startups are going to require a business plan. All lenders ask that you do the work. It's good to ask for the help, but don't have the help or hiring a company to do those business plans and projections for you. You need to do the work. The reason is when you get your files submitted, and if you're working with one of the folks on my team, they're going to look at that and talk to you about the plan, the numbers, and you need to be able to speak to those numbers as to how did you arrive at this? What did you use for your research? So that's why we say do the work. Okay. Projections are 24 months, month over month, not annually. We have to see each month broken down for the first 24 months. If you're a startup or you're an existing business expanding or you're a business acquisition client. All right. In addition, some lenders require 1 to 2 years of personal tax returns, a personal financial statement. That's where you put your personal, not your business, but your personal assets and your personal liabilities, your debt. You're going to list everything out on there. Proof of income if you have secondary income, or if you're a startup, you need to show 12 months living expenses, meaning you have that money saved up and set aside, and that needs to be after the required injection and after what we want to see you have to fall back on in case of anything. So that is on top of all the other injection requirements. If you're in business already, we need to see 2 to 3 years business filed tax returns. So if you're not filed them, you need to get them filed. If you are selling your business or buying a business, those 3 years business tax returns must all be filed. That includes 2025. So if you're looking to sell or buy and you've not yet filed that 2025 business return, you need to get that filed. No lenders will touch it until it's done. And then you also need, for an existing business, a current profit, loss, and balance statement that we spoke about a few slides back. And then again, for mostly for business existing businesses and business acquisitions and expansions, you'll need a business schedule of debt. The form's normally supplied by the lender. Startups, if you've been open for about a year, you'll have to supply one. But if you're a startup, like your doors are not open yet, more than likely you're not going to have any kind of debt to report. So you would just put none on that page. All right, that is the basics for what you need to get ready to submit with your loan application and any other document that may be required by the lender. It varies, but these are the basic requirements. Next slide, please. Okay, so I told you earlier that our company does the SBA Community Advantage loan. This is the parameters of that loan. There are various lenders that do this program. We are one of the largest that does it. Minimum loan amount is $30,000. The maximum for all lenders that do this program is $350,000. That is set by the SBA. The program is a nationwide program. All states that are licensed in all the different states can do this program, or lenders that are similar to companies like mine. You will not find this loan at your traditional banks. Here's the reason why. SBA requires any lender that does the SBA Community Advantage be a nonprofit company. So my company, my segment in our group is a nonprofit so that we can administer this program. So a little bit different than your traditional SBA loan. Your traditional SBA loan will go up to $5 million. That loan is traditionally done at your banks. And there's a few online companies that will do this, the traditional SBA loan up to $5 million online. That is also a nationwide program. This program has a term up to 10 years. The rates will vary from prime plus 2.75 up to prime plus 3.5. This program has no prepayment penalty, and collateral may be required. It depends on the industry, depends on the strength of the borrower. So there's a few variables to it. So that's why I say it may be required. Okay. Next slide, please. All right, another program that's done throughout the different states is a microloan. So if you're looking for just a smaller loan amount, $50,000 or less, this may be a better suit for you. It has a 7-year term. The rate is fixed at 9.75. And these are normally guaranteed by each individual state. The funds come from the SBA, but they're guaranteed by the states normally. There's normally no prepayment penalties also on these programs. And the microloans normally move a little bit quicker to close because there is no collateral requirement needed on these ones. You can be a startup and apply for a microloan if you're not needing very much to get started. Both programs, home-based businesses are eligible. So if you're starting off in the home office and then you're hoping after the first 12, 24 months to move into an actual business location, you are eligible for these. All right, next slide, please. All right. Standard requirements for these programs, for the SBA program, Community Advantage program. Your injection, which is what us lenders call that, out in the consumer world, it's known as down payment. You need 10% for a startup or a business acquisition. You need to have direct industry experience of 2 years. That's normally in management or previous ownership. You need to have a minimum FICO score of 650. You cannot have any of the openings that you see there, no open liens, judgments, collections. Your credit report needs to be pretty clean. You can't be past due. You can be on a payment plan. Your bankruptcy needs to be discharged for 7 years or more. Now, that 7 years or more, that will vary by the various lenders. It could be 3 or it could be up to 10. So I kind of hit right in the middle at 7, just gives you kind of an idea. Most lenders will show on their program info if there is a requirement. Liquidity requirements for startup business, additional funds after closing. This is what I was saying earlier in regards to the post-injection liquidity will vary from 10 to 20%. It'll depend on your loan amount and what any unforeseen cost. Cost overruns comes into play when you have tenant improvements being done at your location. Sometimes those don't get done on time, and then you have additional costs that incurs. So you need to show the lenders that you have the liquidity on standby if needed. Secondary source of income is required on the SBA programs, all SBA programs. It helps if there is additional liquidity, if there is not sufficient cash on hand to cover your living expenses. That's where that secondary source of income comes into play. So we have some startup business owners that will continue working their job until the company is ramped up enough to support them. That's fine, but make sure you indicate how you're going to work a full-time job and launch your business full-time as well, okay? SBA loans require you to be hands-on, or as we say also, if you're buying a building, you need to occupy it. You can't rent it out. Well, a percentage of it you can, but we need to see that you're in there. All right, those are your standard requirements for the SBA loan. And then next slide. All right. So those are some program requirements. Now, here's a couple of success stories that my team has done recently this year. Next slide. So here was a franchise, a startup franchise. The loan request was $350,000. It was the maximum request. This franchise is actually nationwide. The proceeds were used to pay for one territory, some tenant improvements, as you could see, electrical, plumbing, drywall, painting, carpeting, lab equipment, furniture and fixtures, and then working capital to cover the ramp up period, which we look at your projections to see what is your break even month. We make sure we're actually required to make sure you have enough working and operating capital. Next slide, please. Okay. The next one here was an expansion. This was a contractor, glass and glazing. They do various work with glass. They needed working capital to hire more employees and purchase inventory for a large upcoming project. So that kind of covered the receivables and the payroll to cover those projects. Traditionally, we would like to see existing businesses obtain a business line of credit, but sometimes we understand some businesses can't get approved for those. So that's when normally we'll see these types of business requests coming over to us, okay? So those are just a couple of loans that one of my team members has done based in the Bay Area. And those are the two. And so we're going to move into the question stage. And next slide. All right. So let me move my screen around here. Now, I believe we have some questions in the chat box already. So let's kind of go down the questions. Okay. All right, first question is, I believe this was sent in prior to, Question was, lenders evaluate multiple factors, not just your credit score, credit history, cash flow, capital collateral, and industry experience, and help determine loan readiness and overall risk. Which area do you think is the most challenging for you? So as a lender, the most challenging is technically the cash flow. If you're an existing business, we love our CPAs, but we all know that their job is for you to pay less tax than you want to. So they're really good at writing everything off. The problem is, when you get to your lenders, we can only add back certain things. That's a federal line item. So I always recommend, don't just drop your tax returns off to have your CPA do your returns. Sit down, have a conversation with that CPA and tell them your plan for the next 2 years, because remember, most lenders are looking for 2 to 3 years on your filed tax returns. So you got to be able to show some net income there. So cash flow is the hardest. Next question. Cash flow is one of the strongest indicators of loan readiness. Lenders want to see enough income, business and personal, to comfortably support debt repayment and ongoing operations. How often do you review your business cash flow and financial projections? As I said earlier, that should be done monthly. You should be reviewing your profit and loss on a monthly basis when they're done. Remember, they're due by the 10th. So if you're applying for a loan, let's say you're applying with me today on the 14th of May, I would be asking for your April year-to-date profit and loss. So that would be January through the end of April.
Penny,
Yes.
so can you scroll down to the bottom of the chat?
Yes. I see it here.
What are the
typical approval timelines for SBA and other small business loans, and what factors can speed up or delay the process? Good question. Okay, so I'm going to give you a couple of scenarios. Traditional SBA lending done by the banks is normally a 60-day process. If you are doing ground-up construction, that could lead up to 90 days. Okay, if you are doing small business lending through lenders that are typically our company size, we normally timeline start to finish are a 45-day process. Okay, start to finish. That means you supplied everything in the beginning. We pre-qualified you. We got you into underwriting. Underwriting got through the file. They approved it, sent it to our funding department, and now you're getting ready to fund. Start to finish is 45 days. What are the factors that push those timelines? Being prepared, having everything ready, sending your documents as a PDF file. Don't send images 1 page at a time. It takes a lot longer to download. It takes a lot longer to review, because we have to review every page. So compile everything into a PDF. And then when everything is sent to you, you can definitely send over as you complete. And most lenders will build your file. And then when everything is received is when they're going to do a full review and determine whether you meet eligibility. And there's enough info there to pull all your reports. Most lenders will do a soft credit pull first, so we don't ding your credit. And then if we see everything meets eligibility, we look at it and go, this is something we can consider, then we will do the hard credit pull. That's how it should work. That's how it works at our company. So I say that's how it should work, because not all lenders are the same when it comes to that. So, but that's your typical timeline. All right. Let's see, were there any other loans up in? Okay, there's one more in here. SBA Community Advantage loan is only offered by nonprofit companies. Microloans come with fixed rate. Okay, those are just topics. Okay. All right. What are some of the most effective ways small business owners can strengthen their business credit and improve their chances of getting funded? The biggest thing is on business credit, you obviously just want to make sure that you're paying on time, that you're not over your limits. We see a lot of business credit cards are getting over their limits. So you owe more than your limit. Try to keep those in line, maybe pay those off monthly if you can. That would be the biggest thing on business credit. Okay. Are there questions on the floor? Because it looks like that's it for the questions in the box.
We have one more question. For businesses fulfilling government contracts, what short-term financing options are available to help cover inventory purchases and upfront operating costs?
Right. So you still have all the options. If you've already obtained your government contract, it's been approved, you won the request, the RFP on there, you can actually supply that to your lender to show that I've got approval. Here's how much I'm requesting to get me to the first payout stage. The type of lending available, you have all options available. If you are a startup business, you're probably only going to have the SBA programs available. There are very few lenders that I know of that will do a startup on traditional commercial lending. If you are an existing business owner, you too will have the SBA option. You should also have line of credit options. Of course, those are based on your receivables. You can do a secured business line of credit. So if you own your building, you can collateralize it with that. But those are your options as far as startups and existing. So you do have options, but those executed government contract winnings are like big tickets. So make sure you send those in. Any other questions we have out there? Well, I think we're good on the questions. If we can go to the next slide then, Danny, if you could share your screen again, please. All right. So those of you out there, I have been doing this for the last few years, and just recently this year actually switched over to now managing the team that does all the loans. This is my team who does this. If you have any questions, you can definitely reach out to me. You may find Mike Dang a little more accessible than myself, but you are always welcome to email me. So my name is at the beginning of the PowerPoint presentation, and Mike's is at the end. Feel free to reach out, call, email with your questions. We are available to answer those for you. You can also reach out to the center. If they don't have the answers, they know how to get a hold of us as well. All right, and I will end it from here. Looks like we've got about 11 minutes before the end. And then there's going to be a poll that is going to be coming out. And if you all could please make sure and do the poll, we would greatly appreciate it. All right, everybody. Hopefully you finished out that poll. We appreciate your time today. Again, reach out with questions. We're here to help make you successful. And we appreciate your time. And that's it for today's segment. Appreciate it. Bye, everybody.